What just happened? I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, France just sent a massive warning to the world. I'm going to show you what's going on in France and why what's coming to every major economy is outright terrifying. Now, let's head over to Bloomberg, where we picked today's story up with a headline, as French credit rating cut on crisis that imperils finances. And this is something I've been warning was going to happen, that governments all around the world were going to be forced to cut spending at the worst possible time, because as we see economy after economy start to head into recession, the proper move for governments is to deficit spend, to inject money into the economy to try to turn it around. But one of the problems coming out of the pandemic is governments all around the world took on a massive amount of debt. But the issue is, as we entered a great period of expansion, governments didn't pay down that debt. They spent even more. And now the private sector is telling France, you've got to cut. And as you're about to see, it's going to send them right into recession. And as this spreads all across the world, governments are going to find out they've got to cut too. An unscheduled change, Moody's lowered its assessment of the euro area's second biggest economy from AA3 to AA2, 3 levels below the maximum rating. France has already been cut to equivalent levels by Fitch and S&P. So what we're seeing from the private sector is telling governments, look, you have too much debt and you need to cut your spending. And you look at the timing of this, and it couldn't be worse, because again, one of the things we need to see as economies slow down is governments spend money to offset that, to try to turn things the other direction. But one of the issues we face time and time again is that in boom times, governments should pay down their debt. They should run very small deficits or even surpluses in most cases, but they never do. And as the global economy heads into recession, we're going to find out after government, the private sector is going to tell them, you've got to cut spending, and there's going to be no way out of what's coming. The decision reflects our view from the country's public finances that they will be substantially weakened over the coming years. There's now a very low probability that the next government will sustainably reduce the size of fiscal deficits beyond next year. So what the rating agencies are telling France is, hey, look, we already know that you can't do this, but you're going to have to do it, because we're going to continue to cut your rating, and that's going to jeopardize, of course, their ability to borrow money. And that is a risk, because we look all around the world. We look to Germany, we look to Asia, we look to the United States, and what do we see? Massive amounts of government debt, huge deficits, and a slowing economy. And that's the exact recipe we see that means we're all headed into recession. The nomination of a new prime minister and the reaffirmed will reduce the deficit, will provide an explicit response. And that's the hope that, hey, if we just keep changing who's in charge of the government, maybe somebody can get this done. And there's going to be hope here that they can cut their spending. But the problem is, as we're about to look at the French economy, they're in desperate need of government spending at a time they can no longer do it. The government's collapse and the scrapping of France's 2025 budget adds months of political upheaval that have already hammered business confidence, with the country's economic outlook steadily deteriorating. And the real issue here isn't the government. That's what they want you to believe from the business perspective, that the issues facing the government are keeping businesses from spending. The real issue here is the French economy is slowing down. We knew this was going to happen because they're so closely linked to Germany's economy, who is a manufacturing powerhouse of the European Union. We know their manufacturing sector is in a depression. So what we're seeing here is the French economy slow down, the government not doing anything to give anyone any form of confidence. But one thing I want you to know from you is, should governments around the world be slashing their deficits, or should they go crazy spending money? Weigh in the comments below where you're from and what you think your country should be doing, because as we look at what's going on with France, we can see in their economy, it's happening all across the world, and we know that rating agencies are going to come down and bring in the hammer and drop ratings and force governments to cut their spending at the worst possible time. As we turn back to the recent manufacturing PMI, this from S&P Global, what do we see? Factory orders in France fall at the fastest rate since May of 2020. We see the sharpest drop in new orders since the first wave of COVID. Competitive pressures are driving firms to discount prices of their goods, and firms are predicting further contractions in output in the coming year. So we talk about business confidence. There's absolutely no confidence when when you read headlines like that, and then we look into the details of what's happening in their manufacturing economy, you see factory employment continued to decline midway through the final quarter of 2020. In many cases, staffing numbers were lowered via the non-replacement of temporary workers. And still, despite November marking a year and a half of continuous job cuts, manufacturers in France were able to reduce their backlogs of work at the fastest pace since May of 2020. So as you see, issues with the government now being forced to cut their spending, what's happening in the French economy is a massive contraction in their manufacturing sector, and there's about to be a huge surge in layoffs. So you look from the government's perspective, they really need a deficit spend here, but they played their cards after the pandemic completely wrong. But they weren't the only ones. Every government around the world did the same thing. And then everyone pinned their hopes on the services sector. Well, what did we find out? That services activity declined at the quickest pace since January. They saw the sharpest fall in demand for French services. Business confidence sinks to 4.5-year lows. Notably, no mention of the government here, and wage pressures push input cost inflation higher. But something that should be going higher, that is your trading account. Let's give you an update on our agricultural commodity trade. Now, we put this out to our subscribers for our CTA Timer Pro and Momentum Timer Pro. It hit on the same day. It said, buy this candlestick right here. We put that out to our subscribers and check, and it's gone up ever since. Now up 8.18% as of Friday's close. And again, we go through the report. We give you the notes on every trade we see here. Going back to October 31st, it said, look, this thing closed over its 10-day volume profile, but I like the setup, and I told our subscribers to buy. Now, how do we do this? We trade both against machine positioning and momentum. In fact, I'm getting ready to make a change to my portfolio, my trading account on Monday. You wonder what I'm trading and why? Jump on that 30-day free trial, because it's going away, because we trade against machine positioning. When we find the market's moving, the machine's got to buy it. Flags on our report. Same with momentum. When we see massive shifts in momentum, well, we flag it on our report. But here's the best part. We run at a proprietary overlay that nobody's doing. Look, if you want to make money trading, now is the time, because again, at the end of the year, that 30-day free trial, it's gone. You get the daily reports, the tradable signals. I go through every trade every day and give you my opinions on them. We back tested all our signals, so we know they work with a high degree of confidence. We give you risk control levels, and once a week on Saturday, we update our entire trade book and stop loss levels. And here's the best part. You want to trade right alongside me. You want to know what I'm trading before I trade it so you can buy first? Well, I'll tell you exactly what I'm doing, when I'm doing it, and you can follow along. Again, links in the description below, because due to rapidly falling intakes of new business, French service sector companies cleared their backlogs of work again during the latest survey. The depletion in outstanding orders was marked at the fastest seen year to date. So here again, we look at what's going on with France. The rating agencies are saying, look, government, you've got to cut your spending. It's really a problem. But then look at what's going on with the economy. You're going to see a massive drop in revenue at a time when a lot of French workers are about to hit the unemployment line, creating what's going to be an absolute disaster scenario for the French economy. How they even escape out of going into a depression is beyond me, but I want to know what you think. Do you think the world's going to experience a soft landing, a global recession, or an outright global depression? Weigh in the comments below, because plans to repair public finances were already derailed this year, but here you see it. Poor tax revenues as consumer spending and corporate profits disappointed. So you see the issue here. They're being forced to cut spending amid a recession. This is not what you want to see. And it's not just France that we're seeing this happen, as Moody's cut Slovak credit rating on fiscal and political risk. Again, they're going to be cutting credit ratings all across the world as increased political fragmentation challenges policy making. In particular, on the fiscal front, despite the government's commitment to reduce the deficit in adherence with EU rules, well, good luck with that. We expect the general government's debt burden to rise further over the next few years to levels above those of similarly rated sovereigns. Again, you're seeing an issue here. Governments can't get control of their spending, and this is all happening at the worst possible time, because governments could borrow money and inject into the economy to try to soften this recession. But because the rating agencies are saying, look, you've gone too far now, you need to get your fiscal house in order, you need to cut your spending, get things in line at a time the economy slowing down, it's about a certain chance that not only are we going to face a global recession, we could be facing an outright global depression. depression. And we can turn to China to see exactly what's coming for countries like France and the rest of the world as China's credit growth unexpectedly slows despite stimulus. So you think back to what's going on with France. Why would credit start to decline there? Simple. Look at the manufacturing sector and services sector. Businesses don't need to borrow, and consumers are not interested in borrowing. And the problem in a debt-based economy is you need the creation of new money. It comes from the commercial banks when people borrow money. And here in China, you're seeing a big problem in their banking system as China's struggling economy has rebounded modestly in recent weeks on the back of more government support, with signs of improvement in consumption and factory activity. But overall confidence remains frail because policies haven't been strong enough to free the economy from deflation. So we know that China's economy is heading into deflation. We've said that there's no way all of the stimulus is going to turn around. It hasn't worked. But look at France. The rating agencies are saying, look, you can't do any stimulus because you have no margin for error. And that's the problem here, is governments around the world are going to need to do it. They're going to have no fiscal latitude. But we look to the U.S. Everyone thinks the U.S. economy is about to boom. Well, look at our banking data as we turn to the commercial industrial lending data. This showed on a year-over-year rate of change, and this is updated every week, and we're only growing at 0.9% year over year. The issue here is you see a slowdown in lending. What happens? Well, you get a recession. That's that gray shaded bar. It happens once again in the dot-com bubble. Now, look, we actually entered the global financial crisis before there was a collapse in lending, and now look, we're at the zero line for all intensive purposes with a mere sub 1% growth rate. Any further slowdown in the U.S. economy, we're going to see a contraction in lending, and that means we're likely to head into recession with massive deficits at a time we know the incoming administration wants to cut the deficit in a big way. The problem is, will they be able to? Well, corporate and mid-long-term loans, which reflect businesses' willingness to expand investment and production, fell to the lowest for November since 2016. As we look back to China here, private investment has been sluggish over the past 3 years and effectively stayed flat. So you look at what's going on in France's economy, you look at that and then spread it all around the world. What do you see? Businesses are saying, look, we don't have any demand, so we don't need to borrow money. We don't need to expand our factories. We don't need to buy new equipment. Consumers are saying, hey, look, we don't want to buy anything either because we're worried about losing their jobs. And next thing you know, you start to see a contraction in credit. And that's dangerous because in a debt-based economy, again, money's created when people borrow from the commercial banks. But as that principal amount is paid back, or worst case, then you see it go into a contraction, well, it means money's being destroyed from the system. And in a debt-based economy, that is the worst possible outcome. It tells you you're going to head into recession, if not a financial crisis. And then we'll see what's going to happen all around the world as China will then cut rates and the reserve rate next year, according to PBOC officials. And this will be mimicked by, of course, central bankers all over the world who will not have an answer to this problem, but they'll cut rates. But I want you to see just how big of a mistake this is. That it's not going to do anything. It's not going to make any difference, except it's going to make the policymakers say, well, we did something. And the central bank will increase the intensity of monetary and credit supply. It has room to further reduce the reserve rate, the amount of cash banks must hold in reserve, from the current average level of 6.6%. Again, this from the PBOC. But look, it doesn't matter, because if businesses are not booming, they're not seeing an expansion in new orders, they don't need to borrow. So lowering interest rates doesn't change the scenario at all. In fact, if they try to refi their debt, the banks might say, hey, look, we're not sure you're going to pay back what you have. Why would we give you a new loan? And then you look at the consumer side of the story. Again, they're seeing, of course, the slowdown. They're risking losing their jobs. Why would they want to borrow? And the banks won't lend to them anyways. So you can see these policies, they do not work at all. And China's top leaders signaled this week that they would adopt more forceful stimulus to boost growth and put a greater focus on consumption in the year ahead. And that's exactly something that France will not be able to do, something Germany's not going to be able to do, the United States won't be able to do, the UK won't be able to do. You look all around the world, Japan, well, they probably can't do it either, because everybody ran too big of deficits. They didn't try to pay that down. They thought the boom times were only beginning, and that is the huge risk, because China's lower for longer pledge has sent bonds now into the unknown. Now, I've said in the past, I believe that long-term rates are going to get near zero in the future, or could hit zero. I want you to see what now the experts are saying in China. Many people said, Steve, there's no way you're going to be right on this at all. But look at this. Investors are now confronting the risk of what once seemed unthinkable. is China's 10-year bond yield sinking below those of Japan, which currently pay around 1.04% and potentially sliding even further from there. Yields of zero remain a long way out, but talk of that possibility to surface, showing how dramatically things have changed in China's bond market, meaning what the bond market is telling the world is that growth and inflation expectations are falling. What they're saying is the stimulus efforts that China's doing aren't going to work. And you look around the world, who is one of China's biggest trading partners? It's Europe, and they're heading into a recession. So you can see exactly what's coming here, and the bond markets are pricing in the central bank rate cuts, reserve rate cuts. All these central bank policies are not going to work. The problem is now we're headed into a downward spiral. Bond yields at 0% are a possibility. He said the central bank will need to take an anything goes approach to stimulus to avoid the economy sliding into Japan-style balance sheet recession. But if you think these other countries can avoid it, if you think other central bankers won't follow in this, they're absolutely going to do that. And so you start to see why France is sending a massive warning all across the world. They're saying, look, the rating agencies are cutting us to the fact we have to cut our deficits at the time our economy is heading into recession. You look around the world, you see this exact thing happening all across every major economy. What it's telling us, my friends, is the bond market in China is saying, look, global growth is going to plunge, rates could get to zero, and all this means is we're facing the high chance now of heading into a global, not just a recession, but an all-out depression. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.